MCX IPF presents Simplifying Commodities, Futures, Options and Indices.
Commodities investing always gains interest when inflation becomes a concern. Since 1991, energy-related commodities and broad commodity indexes consistently exhibited the highest level of correlation with inflation of all commodities. Research shows that commodities tend to be one of the asset classes that is most positively correlated with inflation as calculated by the Consumer Price Index, which incorporates commodity prices like crude oil, natural gas and agricultural commodities. The US Consumer Price Index rose at the fastest pace since 1982. Meanwhile, Eurozone inflation climbed to a record. India wholesale inflation hit 12-year highs. More than three-quarters of countries analyzed by the Pew Research had higher inflation in third quarter of 2021 versus that of 2019. Commodities also tend to be uncorrelated with stock markets, which could add a diversification benefit to your portfolio. The spot price of a particular commodity reflects the current price for immediate delivery of that commodity. And while that's a great news for stakeholders, they may not be of immediate relevance to investors. Investors can't simply buy and hold most commodities. So the most common way to invest in futures is through options and index contracts. These contracts lock in at a price which you can buy or sell the underlying commodity at a specified future date. Over the last 3 decades, commodities have had a statistically significant and largely consistent positive inflation beta, or predicted reaction to a unit of inflation. Using commodities to hedge inflation and diversify equity exposure is akin to investing in a high premium insurance policy. Commodity prices often go up in a period of inflation, so holding them allows investors to benefit from the demand of these assets. Making an allocation to commodities really is about being diversified. A research at Vanguard Quantitative Equity Group found that over the last decade, commodity inflation beta has fluctuated largely between 7 and 9. This suggests that 1% rise in expected inflation would produce a 7 to 9% rise in commodities, suggesting that commodities inflation hedging power has been strong and consistent.
MCX IPF presents Simplifying Commodities, Futures, Options and Indices.
Brought to you by MCX IPF.